The panic of 2023, haven't you heard? Well, in today's video, I'm going to explain why the banks are freaking out. You have to understand what's going on here. It's fundamental. This isn't the same issue from 2023. It has actually been compounded and made worse. There's something else here that the Federal Reserve is going to have to do something drastic, something we haven't seen in years. How does that sound? Let's get into it right away. I want to note, but I've been talking about this for months more than this. There are deep fundamental problems that won't be resolved without the inferno of inflation. And that is what needs to be understood. You have a crisis and you deal with it with what? That's right. Inflation every single time. Every time they go ahead to the printing press and they put it on full blast. They run it 24/7. And of course, that means prices of everything will go up. Specifically, risk assets are the ones set to go berserk, but not until there's a crisis, not until the Federal Reserve has an excuse. And in today's video, I'm going to show you what that excuse is. Let me get into it. You could see that there's an issue going on with Wall Street not being sure that it can handle all of Wall Street's bonds. What am I discussing? Well, let me just break down the basics. Number one, banks are actively panicking about rates being too high. That's fundamental. You can see this. Interest rates go up. Now suddenly they're saying, uh-oh, we got to be able to get more in so that we can give that out. Because just like any stock, anything else, the banks have investors in a sense, depositors. That's their investor. And if they don't treat them well, they're going to go to another institution that's giving them more. So that's part of it. Okay. Here we have stock prices have largely ignored the bond market. So the bond market's sending all these signals that there's a concern, but the stock market's kind of just saying, meh, I'll shrug it off. Another bank crisis would activate the Fed's QE program. QE is quantitative easing, that's printing money. Whereas we have currently quantitative tightening, or QT. And when you do that, you're draining liquidity from the system. And when that happens, you get problems. Just like you're seeing with droughts in some areas where you can't have the boats going through because there's not enough water. Well, then what happens? Well, you have a problem getting stuff to where it needs to be. That's currency, current. And without that, it's simply going to have issues along the way. Uh-oh, we can't get the products there. We can't get those products there. And we have some upset people along the way. So think about it in that respect. Let's break this down. Investors long shrugged off U.S. deficits, but a torrent of treasuries is testing the bond market. And so ultimately what's going on is that let me break it down for you, okay? So the government needs to spend money. And how does it do that? Well, it basically says, okay, we're going to spend this cash and we will issue a bond. We're going to issue that bond, and that means that an investor will come in and buy that bond, and we're going to give them a percentage. We'll give them 2%, we'll give them 5%, whatever the case is. And so that allows us to spend money. And as long as investors are willing to buy that debt, we can go into as much debt as we want. And the US has been doing this for decades and decades and decades. And that's fine, as long as they can give them a rate of return, and as long as there's enough investors coming through, that's fine. There's just one concern though. Well, when you have a government that goes into way too much debt, and then investors are a little bit more cautious and maybe they're going this direction and that direction, and suddenly the debt piles up. Well, then you have one alternative. One alternative. Who could come to the rescue? Can you guess? What do you think? Who would come to the rescue in that? If there's not investors, whether it's domestic investors, foreign investors, institutions, hedge funds, and so on, who then comes to the rescue? Well, let's talk about it. Okay. So in here, there are a few quotes that I just want to show you. And I think it's important just to understand that, as they say, stocks are valued in part based on how attractive their potential returns are relative to those on treasuries, meaning all else being equal, More bonds at higher yields means lower stock prices. Few on Wall Street expect the torrent to slow soon. And now we've got this big concern, this problem that's going on where we have the investors out there, their whole business was running on super low interest rates. You have investors, the banks, the hedge funds, and everything. Low interest rates. This is the new the new world. Always going to be low interest rates forever. Inflation came through. Oh no, inflation's transitory. We're going to stay down here, but that didn't happen. Federal Reserve increased interest rates again and again and again and again. They did so many times. Each and every single time, the market believed, no, that was it. That was done. They're not going to do it. Everybody all the way through, the YouTubers, the articles, everybody, they all said the same thing, that you don't have to worry, because the fact remains that the Federal Reserve is not going to increase interest rates. They won't do it anymore. They're going to bring it down. Look, let's be clear. We are well into this, well over a year of interest rate increases. So let's get serious. Let's be honest about it. There's another factor here, though, and it goes a little deeper. Treasury's debt deluge is finally straining U.S. funding markets. Levels will be a challenge for liquidity-pinched banks. So as I alluded to a moment ago, you've got these banks, and they have customers. Those customers give them the deposits. Those deposits are then they're able to use this fractional reserve banking. And so they can take this money and then they can loan out many multiples worth. But they're concerned because they always need that liquidity there. If even a small percentage of people start to pull their money out, they got a big problem. So what's their concern? Well, they made a lot of investments when interest rates were super low. They were buying perhaps 30-year bonds. They were buying all these things that were really long dated, but now the value of them has come down a lot. So let's just say in some cases it was like 50% of their value. So did they sell and take a 50% loss, or did they hold on to that and hope at some point it's going to be worth more? Well, it depends on the company and depends on what they're doing. But now they don't have liquidity. If they're going to hold on to it, there's no liquidity there. But the depositor might say, I want my money back. And so this is what happened with SVB. And it's been magnified now because interest rates are even higher than they were in March. At the same time, you've got, basically the rate of return. People want more. They're demanding much more than they were in March. At the same time, you've got more debt than ever before. And so all of these things combine to make it worse than it was back in March 2023, where you had banks like SVB failing. I hope I made my point clear. If I have, if you appreciate this message, hit that thumbs up button. You are supporting me when you do. I want to get into this more. There's even Ray Dalio talking about the concern, the obvious concern at this given time. The Treasury's barrage of bill issuance is starting to cause some cracks to appear in the US dollar funding space. And that brings us into the reverse repos. It's confusing. It's a lot. I know. Just all you need to know for this time being, for the purposes of this video, it's a way for the Federal Reserve to add liquidity into the system when they're doing quantitative tightening. That's it. That's all you got to know for here, okay? So that's their way of kind of balancing it out. But what has happened here is that they believe the market is stable enough to do less and less and less of these repos. And so that's been happening. It's going on with the banks and between the Federal Reserve. So you have the primary dealers, they're called, like JP Morgan and so on. And then you have the Federal Reserve. And they basically just shuffle this stuff around. It's like an overnight investment. And so they can go into the market, get a small rate of return. That's the banks. They do this differential, that's their profit in a way. So the banks are able to make money off of this. But that's now coming down. It's come down quite a bit from where it was at its peak. And now I'm trying to not make it too complicated. The point is that they are actively, right here and now, going into a world in which that liquidity is seriously being drained out of the system. So They are trying their best. The banks are trying their best to keep reserves in the system because they know that the customers are going to be active. They're concerned. They're still worried about what's going on before, but at the same time, they want more rate of return. They're going to money market funds. They're going elsewhere. And that presents itself with an issue. Now, still today, as of right now, the reserve requirements for these banks, what do you think it is? Like 10%? Is it 12%? How much they have to keep in at the Federal Reserve to, make sure everything's good. What do you think? What do you think that rate is currently? Any guess? How about zero? So since 2020, the Federal Reserve said, you got to keep zero in. You don't need to have a reserve right now because things are tough. They haven't changed it. But still, they are worried because they don't want their bank to go under. So this is the big concern. This can't be resolved right now. You still got zero reserves. You've got liquidity being drained like crazy. And you've got the customer saying, I want more return. Inflation is high, and so I want a return. That's a big problem. That is a big problem. And Ray Dalio said that in there, okay? It is expensive to maintain deposits, but banks appear willing to pay the price. Banks likely want an extra buffer of cash due to the rapid deposit outflows and to manage shareholder perception about their overall liquidity. So that's going on right now. I need to make that clear for you. All right. Quote, we are uncertain of the macro conditions that will prevail when the overnight reverse repos deplete to zero. A higher for longer environment and continued bank deposit outflows could contribute to banks remaining liquidity strained towards the end of 2024, which risks funding pressure. This all ties together. Do you see what I just did there? It might have taken me 10 minutes, but we did so. Okay. So the explanation of that, the simple layman's understanding is there's liquidity being taken out. So you pump money in. Imagine it's like an ocean, like this thing's just flooding. This thing's filling. It's going crazy. It's going wild. And then someday you have, and by the way, everybody's partying. One day somebody pulls the plug on the drain and that bathtub starts swirling down. And at this point in time, you realize who's swimming naked. That's going on right now. That's what's happening at the banks. I have seen other YouTubers and what they're talking about, and my goodness, this needs a video every day because we need to understand the intricacies of what's happening, not the nonsense, not the BS, not the stuff about who cares about this and that. We got to know what's happening in this. No more ranting. Okay, look what's going on with the debt real quick. You can see it for yourself. The quantity we have to sell is a lot, and the buyers are less inclined to buy the debt. That's Ray Dalio. They're less like this. We're talking about the U.S. There are deep concerns about financing we're looking at, given the inconceivable gaps between Washington's warring parties. Big problems go real deep. Debt delinquency, expectations unable to make minimum debt payment over the next 3 months. Of course, when you increase interest rates, these are a concern. It's not just for the country as a whole or corporations, it's people too, all over the place. This is now the greatest Treasury bear market of all time, 2020 until today. You can see that. Can you believe that? We are in that time right now. So this is the concern, and this is all going on. I brought it full circle. I hope you appreciate it. I know it's really complicated, but if we don't understand this, we're not going to understand the reason why this is chaotic. And you will hear from the other YouTubers who are telling you that this is a deflationary event, that everything comes crashing down. Yeah, the bond market, big problem. You see that right now. That's what I'm talking about. I wrote it in my book. I put it in black and white. January 2012. How many others put that kind of stuff in black and white? You increase interest rates, you create problems. That's happening. So you, the individual, there are things that you can do, and we'll talk about that. Okay, you have to take action. You can't just sit here and say, oh, that was a good video. Okay, on to the next one. You have to take action. Very important. Okay, and so this is the problem. Yeah, oh, it's deflationary, as if that's where it ends. Come on, people. Come on. Anybody who says that, anytime you see that, you should start to say, I've had enough of that. We got to look at where the money is going to go. And it is very clear that as soon as we have a crisis, the Federal Reserve and the government itself are going to react. And the Federal Reserve might do it through a backdoor channel, or they might just overtly go through. And guess what? If inflation's not down and they're already beginning the next round of QE, what do you think is going to happen to the prices? What do you think is going to happen to the value of your dollar? It's going to burn an inferno of inflation. I can't tell you anymore. Please. You got to get your stuff together. And I have done this. I have made it simple for everybody. I'm pleading with people. Only 500 people have gone through Compass at this point. You got to get your finances together. I made it free. There's no email. There's no dollar. Didn't charge you 99 cents. There's no, a paywall behind there in any regard. You don't have to be a member. There's no email, nothing. You go to my website, themoneyGPS.com, you click on Compass, you go through. You've got to organize your stuff, please. I don't know how to, I'm begging people to do this. I made it free. Comment of the day. My question is this: when will we hit bottom in the commercial real estate market? You've got to be very clear on this thing about, look at 2008 crisis, 2009 stock market bottoms out, it starts to come back up. Housing didn't happen. So commercial real estate, in the case of residential real estate in the previous cycle, it took like 3 years to kind of bottom out and start coming up, 2 to 3 years. So the same thing could be expected again. Real estate moves a lot more slowly, and maybe commercial real estate could be longer. So that's what I would say. That's what I replied in this case here. I want to thank you for your comment. Really, really quickly, look for the beginning. This is what can I do? All right. Look for the beginning of an outright or backdoor QE. This means that risk assets become a buy, and that's crazy. I'm not telling people to buy, but what I'm saying is, you devalue the currency, the worst stuff becomes higher in price. Liquidity is what determines markets, not revenue, not how many stock buybacks and how much earnings. Liquidity. That's what we talked about today. If you want more information, please let me know. I'll talk about it more. Watch the moves of the other central banks too. Don't just look at the Fed. Other central banks may foreshadow what will happen where you live. If you found this video informative, hit that thumbs up button. I want to see you here tomorrow. Don't forget, each and every day I bring you the latest and greatest. Take care.